I'm Dan Coatsworth. Today I'm joined by Simon Barnard and Will Morgan from Smithson, and they're celebrating 5 years since the launch of the investment trust. So Simon, what has been Smithson's biggest success story since launch?
Our biggest performing stock since inception is MSCI, and we've held it throughout the entire period. That's up almost 250% since inception. And this is, a fantastic story. MSCI obviously being the benchmark provider. So it's a very, very high margin business that tends to grow with assets under management in the overall asset management space. It's had further tailwinds from shifts into ESG metrics and benchmarking, and that's obviously set to continue. So it's been a fantastic success story for us. But perhaps more interestingly is other companies that we've switched into that have performed very well as well. And that includes Fortinet. So this is, again, a company that's done extremely well for us. But it's interesting because we owned a cybersecurity company called Checkpoint. Fortinet also is in cybersecurity. And we did notice that Checkpoint was losing a lot of market share. And one of those big gainers was Fortinet. And therefore we switched those companies. And since that point, Checkpoint has done very little, in fact, in share price performance. But Fortinet has done well over 100%. So again, that was an extremely attractive opportunity to switch from a share loser to a share gainer. And as we all know, cybersecurity has continued to grow in terms of demand.
Where are you seeing the best opportunities now?
Well, frankly, we see opportunities everywhere, yes. More specifically, if you look at what we've been doing, and as Will mentioned, 2022 was a year of taking advantage of opportunities. We have even more today. So over the last 18 months, we've added 7 new companies to the portfolio. Put that into perspective in terms of the opportunity set. From inception up to the end of 2021, we only added 7 companies in total. And so that suggests that when we look at where we are buying, it is predominantly industrial companies. And I think the opportunities are coming there because the market is so worried about a potential recession that a lot of these companies have been marked down heavily in valuation, but they're still fantastic companies with extremely strong balance sheets and business models, which means that they can easily make their way through any type of recession that, should we see one, we may not. And so we're very comfortable owning them today at these, what we consider bargain valuations, knowing that we're going to own them for the long term.
And I think the other interesting thing about industrial companies is because often they sell to other companies that are then making something which eventually they'll sell to the end customer. So while people are worried about recession, actually a lot of these industrial companies have already seen some kind of downturn because there's been lower demand in the supply chain because of all the disruption caused by COVID. People were buying lots of product from them and then had enough, and so were buying a lot less. And the fact that they've seen that downturn happen, they've already weathered it and are trading at low valuations, as Simon says. I think that's one of the reasons that area is becoming quite interesting.
So you recently declared a new position in Croda, only for the company to issue its second profit warning in 5 months soon after. Now, did you make your first investment after that first profit warning from Croda? And if so, why were you taking that risk when it was pretty clear that there were some near-term issues with that business?
So to answer your question simply, we did buy after the first profit warning, quite a long way after the first profit warning, just before the second. But in the full expectation that there may well be a second, and I think the market was kind of aware of that. I think the broader picture, just as a quick bit of background for those who don't know, Croda is, we think, a very high quality business. It makes ingredients for things like consumer care products, but also for pharmaceuticals, and in particular, which is pertinent to this story, for the mRNA vaccine that Pfizer used to tackle COVID. As you can imagine, that led to a very strong performing period during and just after the pandemic, which has unwound against it as those sales have fallen away. And at the same time, its customers in the consumer care world are using up some of the inventories of products they have from them, so demanding less in the near term. And that caused the profit warnings that you talked about. The reason we bought it at the time, even though we knew there might be another one, is that we felt this was presenting an opportunity to buy a high quality business at a relatively low valuation. Because one thing we've learned is that it's rare that you get to buy an obviously great business at a very cheap price unless there's a glitch of some sort. A good example of this is Equifax. It's a bit like Experian. They do consumer credit reports in the US. When we launched the fund, this company had just been hacked and lost details of about half the US population. Its share price came under huge amounts of pressure, and that gave us an opportunity to buy into it. Now, we did not pick the exact day that that share price bottomed to buy it, but as a rough period to buy it in, it was a good one. And that's our feeling with Croda, that this is a period in which it's a good time to accumulate a position in a high quality business. We've never pretended we could pick the exact day of the bottom. Yes, we did buy it before the second profit warning, but we kind of expected it to happen, as did the market, I think, to some extent.
Well, thank you very much. I hope you enjoyed hearing from Simon and Will, and thank you for watching.